Okay, right. Now let's have a look at over and under absorption of overheads. So now a new example will be given to demonstrate how over and under absorption can work. Now let's have a look. If you look at here, you will see that the selling price per unit is £20. We have the direct material per unit £8, and we have the labor cost per unit £3, and we have the variable production overhead per unit £2. So if you add them together, that comes to £13 per unit, and this is the variable cost per unit, or we call it the product cost per unit using variable costing method. Now, in terms of the data here, budgeted fixed production overhead £30,000 per month, and the budgeted production volume 10,000 units per month. So we expect, this is our budget, our expected budget, our budget to produce 10,000 units per month. And we calculated the fixed cost £30,000 per month is based on the 10,000 units production volume. In this case, if you divide £30,000, if you divide it by 10,000 units, you should find out that the fixed cost per unit equal £3. In this case, if you go back, you will see that £13, this is the product cost per unit under variable costing. If you add up the fixed manufacturing overhead element, which is a £3, so you should be able to have £16 the product cost per unit under absorption costing. So far you need to understand that the budgeted sales should equal the production volume. What does that mean? This means if we produce 10,000 units a month, we should be able to sell the 10,000 units. If we produce more or produce less, that comes with under or over absorption. Let's have a look now at it. Now, from January to June, production and sales were 10,000 units per month as budgeted. So there's no issues here. Production and sales are were equal from January to June. There is no problem here. So we need to ignore this, please. Now let's come to July then. Production was 10,100 units. Sales were 9,700 units, that leaving 400 units in inventory as unsold goods. So now think about it for 1 second. Our budgeted production units is 10,000 units, and we calculated the fixed cost, the fixed manufacturing overhead, £30,000 based on 10,000 units of production, budgeted production. But what happened in July right now? We made extra 100 units, yeah? Instead of 10,000 units of production, we made extra 100 units. So how it works now? Let's have a look. If you look at absorption statement, you will see that sales 194,000 because we sold 9,700. If you multiply it by the selling price per unit, £20. So we don't have opening inventory. The cost of production or cost of manufactured, good manufactured is £16, which is, if you remember, the product cost per unit using absorption costing, the £13 plus the £3 fixed cost per unit, multiply the number of units produced, which is 10,100 units. Now you need to stop a little bit now and think. Okay, you need to think. The £30,000, the fixed manufacturing overhead, okay, is calculated based on what? Based on 10,000 units production. But now we produce more, so we produced extra 100. Is it justifiable that we increase the cost of production will be more because we produced more? Yeah, is it justifiable? Of course not justifiable. Why is not justifiable? Now for the 100 units, yeah, for the 100 units extra, okay, we can justify the £13, which is the variable costing element. Because remember, the product cost per unit equals £16. £13 of them is variable cost related to material, labor, etc., and £3 is the fixed cost there. We justify the £13 element. Why? Because if we produce extra 100 units, this means we need extra material and labor. That's fine, no problem. £13. But how about the £3? The £3 fixed cost per unit, is it justifiable to add it on the cost? No, it's not justifiable. Why? It's not justifiable because if the company pays rent £1,000 a month, oh sorry, a day, yeah, let's say a day, okay, and they produce today 1,000 units and tomorrow they produced 1,500 units. Do they need to pay extra rent on that? No, of course not, because it's fixed cost. If you produce additional units, right? If you produce additional units, you don't pay extra cost on it as a fixed cost. And that's why we need to deduct to remove the 100 units times 3. So that called over absorbed. We over absorb by 100 units. In this case, if it's over absorbed, we need to minus it. So less over absorbed, 100 units times £3, because as I said, we only concern about the what's called the fixed cost element, which is £3. So £300, that minus, you need to deduct it from cost of production, 161,600. So of course the closing inventory, easy, the same, it's 400 units, you multiply it by £16, 400 units left, you multiply it by £16, that comes with 6,400, and that cost of goods sold 154,900, and if you take away the sales, you should be able to find profit of 3,900. Again, sounds confusing? Okay, let's have a look. My explanation in very simple way, right? Actual level of production was 100 units higher than expected. Would you agree? I hope yes. A total cost of 16 was charged to each of the additional units produced. So as I mentioned, the £16 is the product cost per unit, and this £16 is broken down into the £13 is the variable cost element and the £3 is the fixed cost element. If we produce extra 100 units, we justify the £13 because, as I said, variable costing, including material labor, we needed. That's what we justified. Was justified because the additional units required additional variable cost of material and labor. We don't have any problem. We don't argue here, but the argument is about the £3 of fixed cost element. That is not justifiable, right? So the fixed cost element of £3 per unit is not justified because the fixed cost does not increase with additional production. This part of the additional production cost charge must therefore be removed. We need to deduct it from cost of production, which is £300. I hope that really makes sense. This is a statement under absorption costing. For variable costing, no difference. Yeah, it's not affect. You do them the same as previous. So there is no over or under absorption costing under the variable costing statement, because anyway, because we are using the 13 pound per unit. We're not using 16 pound per unit to calculate the cost of production. Yeah, so basically it's really simple here to look at. Yeah, can you see? Sales, same, no opening inventory. Cost of production, as you see, cost of production, now we multiplied by 13 pound, not 16 pound. And the closing inventory, again, we multiplied by 13 pound. So here we go, variable cost of goods sold, 126,100, and contribution to fixed overhead cost, so that is 67. So that's 194 minus 12600, and you need to minus the fixed cost, the 30,000, that's 37,900. Very simple, that's as previous. There's no over or under absorption cost. Yeah, and that's just only explanation about variable costing. Again, very simple, straightforward. The difference, as you see, is 1,200 because of a closing inventory. Yeah, can you see when you do the reconciliation? If you remember, the difference would be the closing inventory, and you need to multiply it by the fixed cost per unit. I hope you remember this. So the 400 units, which is the closing inventory, you need to multiply it by the fixed cost element, £3. That's 1,200 pound. And 1,200 pound is the difference between the profit between the variable costing, which is 37,900, and the absorption costing profit of 39,100 pound. Now we've done July. Let's go back to August. August, what happened here? Production was 9,900 units and sales 10,300. So of course, first of all, remember that the budgeted units, production is 10,000 units, right? But what happened here? We produced 9,900 units, so we producing less, so that's under absorbed by 100 units. Let's have a look. Yeah, for August, as you see, right, as you see from August, you see that the sales is 206,000. Why? Because we have 10,300 that units sold times 20 pound, that's selling price per unit. Easy. So opening inventory, remember from July, what we have from July, we have 400 units times 16, we are doing absorption, and the cost of production is, again, we produced 9,900 units times 16 pound equal 158,400. Now you need to stop now a little bit, okay? When we calculated, right, when the business calculated the fixed cost of 30,000 pound fixed manufacturing overhead, they calculated based on the 10,000 units of production, budgeted production units, right? So it means each unit £3 as fixed manufacturing overhead per unit. But now what happened really, that we produced less than we budgeted, right? So we budgeted as 10,000 units to produce, but here what happened? We produced less, 100 by 100 units. We are under absorbed. Now think about it now. what is the cost of production. The actual cost of production, it's not 9,900 times 16, but it is 10,000 times 16. Why? Because how about the 30,000 pound fixed cost element? So the business, they pay rent every day 1,000 pound. If they produce 10,000 units or they produce 9,000 units, they still paying the 10,000, that 1,000 pound rent every day. Regardless if they are over or under absorbed, we need to reach to the actual cost of 10,000 units times 16 pound. In this case, as you see, we are under absorbed, right? If under absorbed, we need to add the 100 units times 3 pound, the 300 pound, in order to make it the actual cost of production, which is 158,400 plus the 300 pound here. And that reflects the actual level of production here. Let's closing inventory. We don't have a closing inventory because we sold 10,300, so we sold the opening inventory plus the production. Again, that comes with cost of goods sold 16,500 and sales minus cost of goods sold equal profit 4,900. Very, very simple. Again, let's look at the explanation. Right. Actual level of production was 100 units, level than expected. So we expect, if you remember in the question, what we expect, guys, we expect 10,000 units budgeted production units. But here what happened, we produced 9,900. This is 100 units left, less. The fixed cost element, right, of a £3 per unit must be charged on the expected basis of 10,000 units, because fixed costs do not decrease when a production volume decrease. This is my point here. When we calculated the production cost, we did calculate it based on 9,900, but not in 10,000s. So yes, if we produce less 100 units, that's fine. We can justify the variable cost because we don't need labor and material. But how about the rent, right? How about the salaries? We need to include them here, and that's why we include the extra 300 on the top of the actual cost 300. This part of the production cost charge must therefore be included by adding 300 pound. I hope it's clear. Under variable costing statement, again, what we mentioned, that no effect, no absorption or under absorption under variable costing. You just need to prepare the statement as follows. Sales, same, doesn't change. Opening inventory, if you remember, you need now to calculate it and multiply it by 13 pound. Cost of production, 9,900 times 13, and no closing inventory as we mentioned, and at the end you need to deduct the fixed overhead, which is 7,200. So that comes the fixed 30,000, so that comes with 7,200. If you minus 30,000, you should be able to find the profit of 42,100, and that's the profit under variable costing for August. So now let's have a look now exactly what happened here. So under absorption, under absorbed overhead, the absorption the absorption costing profit is less than the marginal costing. The difference again is 1,200. Did you remember why did I say this? Remember the difference. If you want to see the difference in the profit, you need to go and find out the closing inventory, which is, if you remember, the 400 units was a closing inventory. You need to multiply by the fixed cost element there, the fixed cost element there, and that's what you can see. The August, the August 4,200 and August absorption operating profit 4,900. So if you see the difference, you can see that there is 1,200 pound different. That's due to closing inventory. However, if you go to add them all together, yeah, if you add the profit together, you should be able to find there's no difference in operating profit. Why? Because the question from September to December, it tells you that the sales equal the production units. So you expect from August that there is no closing inventory. So if you add them up all together, profit under absorption costing together and under the variable costing together, you should be able to find out that all of them are equal because there is no closing inventory. Great. This is an example for you guys. This is for 5 months. You need to practice. So we have covered the methods of absorption and variable costing, and this is a way how to practice it, and hopefully you will get it right. Of course the answers are there, but I would recommend you do not look at the answers. So do it in your first in your own, and then you can look at the answers and find out what happened. So let's quickly recap for the last couple of minutes. So if we go back, we agree that absorption costing does include all the manufacturing cost, and that we call it the full costing system. And if we look at the variable costing, we look at only a particular part of cost. Yeah. If you look at absorption costing, you include all costs, including depreciation, tax, insurance, salary, etc., etc. Yeah. But if you look at variable costing, you just need to include the cost which is incurred. So these costs, we did say already incurred, we didn't include them. So the argument is, why do we include rent or salary? Yeah, why do we include it to the product cost per unit? Although I already pay them. I already paid the salary and already paid the rent. So the argument here, why I should include them? If already I pay them, why do I should include the product cost per unit? Yeah, and that's the argument between the variable costing and the absorption costing. And the last slide here, quickly, it does tell you which method is used for external reporting. Remember, as a business, they need to report to the external bodies and for the independent auditing. So remember that a company that attempts to use variable costing, right, on external financial report runs the risk that is not accepted. So remember, the absorption costing method is the method which is accepted by international accepted accounting principles. So remember this. This is important to remember here. Right, here we go. So as you see, it's difficult to to distinguish, or not distinguish. It's difficult to go ahead with variable absorption costing. Some businesses, they go for favor when you calculate product cost per unit under variable costing. Some businesses, they go for favor for absorption costing when they calculated a product cost per unit. It's up to the business to go ahead, but at least now you should be able to understand the main difference between the two methods, and you should be able to prepare the statement of profit or loss under the two methods. Right, have a good day, hopefully, and have a lovely day, and take care, guys. Bye bye.